Hello, R2F here with another video. In this video, I would like to discuss why a top-down analysis is important. And I've titled the video, Riding the Wave, right? Because I think an appropriate analogy is that you want to go with the flow, you want to trade in that direction the wave is in, right? Like if you're sailing, you want to trade with the current. You want to sail with the current and go in the direction where the wind is blowing, not against it. So I think a lot of people, a lot of new traders, they don't want to do a top-down analysis because it's just this extra work. It requires extra planning. What they rather do is go directly on the chart and be able to tell wherever price is going to go just based on that, one chart and one time frame. Unfortunately, that's not how it works. Price is fractal, and it's going through all the motions in different time frames. So there's no one pattern that you can just see on the chart and it'll be able to tell you it's going all the way, to a swing high or all the way to a swing low. But you have a higher chance and you'll have a higher win rate being right about your trades if you were trading in the direction of, the higher time frame order flow, but catching a trade on a lower time frame. So we'll see what that looks like on this chart over here. So imagine price is in a buy model on a higher time frame. Eventually it reaches the top and then it comes all the way down, taking out this low, and then it goes higher. So perhaps the narrative is higher prices, but we have a retracement taking out a swing low or pool of liquidity, and then we move higher. All right. So this is a higher time frame, and generally you want to trade in that direction, because I think most people are trading CFDs or even futures. You can leverage your positions, so it doesn't matter what time frame you're on, but it's good to have a higher time frame narrative relative to the time frame that you are either analyzing for an entry or a target. So let me enable some more lines here. Okay, so we see price, for example, this may be a line chart and we see price moving like this. Okay, now I use ICT's concepts, so how I'm going to analyze price action will be based on that. But even so, if you're using any other types of concepts such as just trend lines, candlestick patterns, support and resistance, whatever it is, you'll still want to trade in the direction of the higher time frame, so you'll have a higher chance of being right. So we'll see what that looks like over here. So imagine price making a high, a low, a higher high, a higher low, a higher high, a higher low compared to this, but then it makes a higher high, higher low, and then we see some consolidation. Price breaks down, but then it shoots one more time up, and then it breaks down from there. So perhaps this is a news event that took out a pool of liquidity above here. That's one possibility. All right. And then it breaks down. And then we see a, let's say, an ICT breakout form, and keep following bearish order flow, taking out the low, and eventually bottoming out here before expanding up. Right. So I'll enable 2 more drawings. So ignore the time frames up here that I'm actually on. It says I'm on the daily, but just ignore that. So you can pretend we have a monthly fair value gap that price has traded into. And we know that up here, imagine there's something on the left of the chart just showing many equal highs and basically a large pool of liquidity that we know is the draw on price. So we have this pool of liquidity, and we also have the monthly BISI, which is technically a pool of liquidity as well, But relative to the monthly busy, imagine these are relative equal highs also on the monthly. It's just basically where price eventually wants to reach to after retracing into here. So you have to imagine, or you have to see where you are in price. If you're coming up here, um, perhaps it's already quite high at a premium, so you do have to be careful for a potential reversal. If you were seeing price perhaps from here, then around this point, then perhaps you would think this monthly busy was the draw for a retracement before getting to the eventual equal highs. So although we know the higher time frame um, target are these equal highs up here, and after this retracement, depending where you see price at the moment, we can still scout for many opportunities on the lower time frame compared to where the higher time frame is going, right? So yeah, you can imagine the black line is the daily chart coming into this monthly busy, and you can imagine the blue lines as, for example, an hourly chart. Okay, so yeah, if I saw this kind of move up here and then a breakdown on the 1 hour, for example, and I know there is a fair value gap that price potentially wants to trade into this monthly busy, then I can have that as a potential target. Price is at a nice premium. I could target that. Perhaps in the retracement of this breaker. And of course, stop up here. Um, although I said to imagine there are equal highs up here, but yeah, if you are unable to tell when price is going to retrace somewhere else first before reaching a pool of liquidity, then yeah, do not try and short when they're equal highs or long when they are equal lows. Okay, but this is just an example using a breaker, and now you can trade down rather than a large expansion up has already occurred, however many days. Where at a deep premium, you don't want to be longing, trying to target, even if you're targeting these equal highs or higher time frame targets, you're likely to have a less probability of winning, right? Price comes and then yeah, it just tops you out because you're buying at the top. And you don't want to buy at the top. Okay, if you keep trying to buy at the bottom, then you have more chances of eventually being right. But if you're buying when price has already been pushing up so much and there's no real analysis to that, then yeah, they can hurt your bottom line. So let's imagine now we're targeting these equal highs. When could one get in, right? So we have a low, price comes into the monthly busy, probably comes to one more fair value gap here, makes a low, retracement makes one more low, shift in market structure and trades into a breaker or fair value gap, expands, trades into an order block, starts using the sell side of the curve PD arrays such as SIBIs and bearish order blocks, using them as inverse PD arrays. But anyway, we have that as a target. So yeah, depending on the type of PD arrays you use or whatever you use in your analysis, moving averages, for example, not something I would use, but imagine there's some other moving average and you buy the crossover, right? Over here might be your signal. If you're using ICT's concepts, this break in structure and buying into this breakup there. Stop usually at the low, depending on your entry and your strategy, basically targeting the equal highs, and of course taking partials at various areas. Or you want to buy this order block when price retraces to it. maybe you're more confident on this, and you get on the lower time frame, news event that pumps price up. Whence retail traders may be thinking we're going lower, right? We know now we're on the higher time frame wave, higher time frame buy model. We're going to write this up, and then you can go to a lower time frame and be more likely to succeed in your trades, right? Even for example, even if you get in here, if you stop there, okay, you get stopped out. Maybe you get a re-entry up there, or maybe some other confirmation within here, and you're still able to be on the right side of the market. Okay, so let's go look on a real chart how we might be able to do that. Let's imagine, well, we don't have to imagine, you can just use the replay tool. We see a fair value gap created with a wick, one of my favorite. It's an R2F gap coming for these equal highs. Okay, so in here we came into this fair value gap, larger time frame order block. This expansion up, breaking the structure here. The shift in market structure, order block created. We want to take an entry in this daily busy. That's what we believe is going to happen. Okay, comes in, comes out. That's fast. But let's say it comes in, and now we're waiting on the 1 hour. We have our alert set. We are waiting. Okay, so it comes in here into this nice order block here on the 1 hour. On the 1 hour, not too much to see. Let's go to a lower time frame, like a 15-minute. Okay, you would naturally do this anyway. You see an expansion up, you want to see something on a lower time frame. Okay, so we make a low, come into a fair value gap, make a low, some equal lows, and then we expand up. At this point, what a nice entry is. I think this inversion gap coupled with this fair value gap. If you take it at the high, you would have gotten in. Order block here. This is the kind that I would take. And of course, still targeting the high. You get one here, tap into this fair value gap, and then you create this order block. Since it's already in there, probably get in somewhere there. And where would we target? These equal highs up here. Okay, we see price come down here. Okay, if you're in this trade, you would go and stopped out because now time shifts to a higher time frame. So let's go to the 30-minute. Okay, 2 hours, 2-hour gap, 3-hour gap, 4-hour gap. Okay, so we trade into a 4-hour gap, that was created. So when you see things like this, 5 o'clock New York time, there's a new day, and it's also a new 4-hour. So at every of these higher time frames, you have to, always have to be aware of the higher time frames that are forming. But on 15 minutes, it looks like that, right? And if you had that 4-hour POI, you can say, hey, okay, this order blocking gap, that also looks nice. Get this expansion up on the 15-minute. Enter at market. Stop below here, nice breaker. Target the high. This is probably a news event. Yeah, possibly. Okay, comes in gap, comes into this breaker. Boom. Order block, order block, order block gap. Same like here. Oops. Okay. All right, it comes into a small gap. All right, quite a lot of consolidation at this point. Okay, so it finally comes over this to these equal highs, this pool of liquidity over here. That was the draw. This took a while. Let's see what that looks like on the 4 hours. Before it came into a gap, and then we got a bit of consolidation, some liquidity being built up before we hit higher. This looks like it's gonna hit higher one more time, maybe. Oh, and that's today. Yeah, so that's today. That's right now. So that's what happened. If you're on the 15-minute, this ride could have been scary, of course. But what would be scary is being on the wrong side of the higher time frame and keep trying to get in a position, a direction that's not going to work. For example, shorting here, if you were an ICT student, depending where you put your stop loss, let's say an intermediate swing high, trying to catch this fair value gap to go lower. A lot of the times, targeting a swing low and you get stopped out. And this is the type of accumulation that tries to lure people into getting stopped out, right? Another fair value gap. This is it. This way it breaks down and it keeps pushing up. Comes down again all the way here. People jumping in. Keeps pushing up. There's a big fall. And by the time you believe in it, it's probably down here. You're like, oh, okay. You're crazy. You put your stop at the high or risk too much and price comes up and keeps stopping you out on its way to this pool of liquidity. So that's how you can use it in a live example. Just frame something on a higher time frame. One more time, a gap here. When price is in there, you start hunting for confirmation that price wants to go higher. And then at a nice entry that gets offered, you can target this high and even higher. Okay, so I hope you found that insightful and that you're able to use this concept to your benefit and framing trades in a higher time frame. I know it takes a lot of patience to wait, but this is a competitive industry, and it's not so simple as just going on the chart, looking at a little pattern, and you know making money from one of the highest paying professions in the world. So just put a little bit of time in the higher time frame. It just takes patience. You don't have to actually do anything, which may be the hardest part. But when you get a higher time frame narrative, such as a daily, you get a daily gap, and you have a higher time frame narrative, you can have a lot better trades. Okay, so yeah. Till next time, happy trading and take care.